And what a year it's been. This is a very pivotal year, I think, in the formation of the digital assets industry. They say the two most important days of your life are the day you're born and then the day you figure out why. And I think the extraordinary thing that's happened over the past 12 months is I think a lot of us figured out why. Why are we in this industry? And I'm delighted to be with you today because I want to share my why. And my why is going to cover three pretty profound topics. The formation of a new asset class called digital capital, the formation of a new business model, the digital treasury business model, and the formation of a new asset class, digital credit. And I think 12 months ago, we knew that digital assets were auspicious and we were all very bullish on Bitcoin. But I really think the past 12 months have provided extraordinary clarity about these three topics. So first I'll talk about digital capital. Well, I think the emergent consensus in the world over the past 12 months is Bitcoin is digital capital. There were some pretty pivotal events. The Red Sweep was a pivotal event. The appointment of 12 pro-Bitcoin cabinet members was a pivotal event. When the president said we're going to be the superpower, the Bitcoin superpower, that was a critical event. When David Sachs said Bitcoin is digital gold, a digital commodity, the global commodity, it's March of 2025, when he went on television to assert that Bitcoin was special and recognized for its commodity status. That was a pivotal event. And we bandy about, this phrase, digital gold, and people talk about, is it just a store of value? Can it be successful if it's only a store of value? Well, there's a theme to that, which is the bug is the feature. And I think that the humbling epiphany of the past 12 months is every criticism and every bug in these asset classes, in this industry, in the treasury business model, has turned out to be the feature. And here, store of value means capital. Gold is store of value. And if you are store of value, and if you are digital gold, and you emerge as digital capital, then that is a profound paradigm shift for the entire economic world. So why is Bitcoin digital capital? Well, the politicians say it's digital capital. The banks have embraced it as digital capital. Now we actually have JP Morgan expressing support for the asset class. We have the head of Charles Schwab that's announced that they're going to custody Bitcoin. They're going to let you trade it. They're going to extend credit against it. They're going to let you deposit it and withdraw it in the first half of 2026. That's extraordinary. So what you see now is 12 months ago, I couldn't get a loan against any kind of Bitcoin posted as collateral from any major bank in the United States. Right now, Bitcoin is creditworthy collateral at Merrill Lynch, at JP Morgan, at Charles Schwab, at Texas Capital Bank, at BNY Mellon, at Wells Fargo, and at PNC. And so there's probably a few that I've skipped. I think Citi has just announced that they're going to start to custody and bank Bitcoin the first half of next year. So we have basically progressed through the unthinkable. We've gone from a toxic asset class that the administration was against and the banking industry did not acknowledge to an emerging asset class that's getting the grudging respect of half of the major banks in the United States, and it's spreading like wildfire. And these are the most conservative, risk-averse organizations in the world, and if they go and do a 180 in just 12 months, that's pretty extraordinary. And if half of them embrace this asset within 36 months, I think that's light speed. So you've seen the banks embracing Bitcoin. Now you're seeing Wall Street. Of course, we all know the story of the success of IBIT, the most successful ETF in the history of Wall Street. I've tracked it pretty closely. What's interesting, of course, is it went from nothing to about $100 billion in less than 2 years. But also, if you look at the emergence of the derivatives market on top of IBIT, it went from nothing to $10 billion to $50 billion. And if you look at the liquidity, it went from nothing to trading $4 to $5 billion a day. It's really quite extraordinary. Public companies have embraced this asset. If it's going to be digital capital, someone's got to be able to capitalize on it. There was one company that capitalized on it in the summer of 2020, and then there was 2, and then there was 3, and we thought that was kind of cool, and then there were 20 and 30. There were maybe 30 at the beginning, the middle of 24, 60 toward the end of the year, and we've gone from 60 to more than 200 in the year 2025. 200 publicly listed companies, up from 60 in 12 months, is quite a bit of progress in a single year. So this is an extraordinary dynamic. And of course, the marketplace itself, right? What we see is 700 million crypto believers. The crypto industry tipped the election last year. It's becoming the most powerful, if not the most powerful, political movement in the country, and it's global phenomena. And if you're going to be global digital capital, then you probably want to rest on liquidity. So you're staring at $60 billion a day of liquidity, but on Friday, I think we had $100 billion trading. So it's an emergent, powerful asset. It's electrically powerful, it's computationally powerful, it's economically powerful, and it's politically powerful. And it's never been more powerful. So that observation, Bitcoin is digital capital, is key. We are capitalists. The capital assets of the 20th century: equity capital, real estate capital, credit-based capital. Most of the world thinks private equity, public equity, and real estate is primary capital. The emergence of digital capital is pretty profound because it represents an alternative to people who don't perhaps want to store all their wealth in real estate. As I've said before, there's really no real estate in Africa you probably want to put your family savings into for the next 100 years. There are lots of parts of the world where people just don't want to store their economic energy for long periods of time. So the emergence of digital capital is a global phenomenon. It's also a political phenomenon. It's also a technical phenomena. And of course, if you pair the emergence of digital capital with the emergence of digital intelligence, you can imagine that in a world with 1 billion AIs talking to 1 billion AIs 1 billion times a minute, they're not going to have a lot of patience for 20th century ways of doing things. They're not going to buy sports teams. They're not going to buy fiat sovereign debt capital. They're not going to store their money in cash. They're not going to trade gold. They're not going to want to store their capital in buildings or cross-trade commercial real estate. They're certainly not going to be comfortable with securities and all of the human and legal and political restrictions that come with them. So the emergence of digital capital at the same time as we have an emergence of digital intelligence is, maybe it's a coincidence, but maybe it isn't a coincidence. Maybe it's an inevitability. So the second point I want to focus on is the emergence of the treasury model, of a digital treasury model. What is it? A treasury company is a company that sells securities to buy a commodity that it then capitalizes on and then issues credit against the commodity. So if you sell securities, raise capital, and then issue credit against the capital, you've created a treasury company. There traditionally haven't been a lot of treasury companies because the SEC 40 Act prohibited publicly traded companies in the United States from capitalizing on securities portfolios. Everything that I'm going to describe you could do with the S&P index or a portfolio of Magnificent Seven stock, except for the fact that regulations in 1940 put in place by the United States make it illegal. And so because you could never have more than 40% of your liquid assets sitting in securities, you find Warren Buffett's got to continually trim his position in Apple stock. He's got to sell his securities. He's always got to keep 60% or more of his liquid assets in treasury bills. And it turns out that most of these mathematical methods don't make any sense if you're using sovereign debt as your capital asset for economic reasons. So we inadvertently discovered a new business model. There's insurance companies, there's banks, there's all sorts of business models. This is a treasury business model. And how does it work? We sell equity, we sell credit, we sweep cash flows, we buy Bitcoin. We've done it 85 times. We found ourselves with about 3.1% of all the Bitcoin in the world. We spent $48 billion to buy it. It changes value every day, plus or minus a few $1 billion. Doesn't bother me, it bothers other people. I rather like it, I enjoy it. We've gone from an irrelevant company to the 5th largest treasury in the S&P index. You can see the chart. We'll be the number 2 in the next 12 to 24 months. I expect we'll be the number 1 in 4 to 8 years. There's only one company on this chart other than ours that has a practice of accumulating capital, and that's Berkshire Hathaway. Every other company on this chart has a practice of surrendering capital. And so one of the big ideas in the treasury model is instead of surrendering capital enthusiastically as fast as you can and bragging about it, you might want to keep the capital. Every big bank, every time they have a good quarter, they increase their dividend and increase their buyback as though that's an accomplishment. Every big tech company increases their dividend, increases their buyback as though it's an accomplishment. It's not an accomplishment to surrender your money, right? If you walked into your dining room on Thanksgiving and told your family that your idea to improve the family was you're going to give away all the family's money. That way we won't have a volatile balance sheet. It's not good for the family, right? I think intuitively you know that it's not a good idea for you to give away your money. And you know it's not a good idea for your family to give away your money. But somehow, somewhere along the line, the conventional wisdom in corporate finance is that money is toxic, capital is bad, and the most shareholder-friendly thing you can do is decapitalize the company by throwing all the money out. Now, of course, the irony is the best-run companies in the world are in the business of getting rid of money. And that leaves the investors to figure out what to do with the money that's being surrendered by the well-run companies, and there's a certain irony to it all. It comes about because they're all capitalized on the wrong asset. You can see here, in the last 5 years, the cost of capital is 14%. It's the S&P index. Turns out the gold is tracking it. You have two interesting capital assets: metallic capital, gold; equity capital, the S&P index. 14%. That's your hurdle rate. Money markets pay you 3%. Therefore, you're destroying 11% of your treasury assets every year that you hold money markets. Bonds are minus 4%. That's how you bankrupt your bank. The Mag 7's double that number. Bitcoin's double that number. Our company outperformed Bitcoin in the time frame. If your company is capitalized on an asset which underperforms the S&P, then you're negatively polarized to capital. It's toxic to you. So you're going to throw it away as the rational thing. If you're capitalized on a product like Bitcoin that outperforms the S&P, you're positively polarized to capital. You attract money. In fact, the more money you raise, the more profitable you become, the more shareholder value you create. It's a very simple idea. Flip the polarity from negative to positive, and then you just get stronger every single year, and you'll get more powerful. But as you can see, right, the reason that you can't capitalize on the Mag 7 is the SEC 40 Act. And you can't capitalize on the S&P index because the SEC 40 Act. I guess in theory you could capitalize on gold. Interestingly enough, no public company has really done that. And the point that I make to the gold bugs is even the gold miners don't do that. And if the gold miners aren't doing that, then there must be an issue. I don't know what the issue is, but what I do think is the general tendency of corporations is you throw away your money to the investors, and the investors buy the index, and that's how they keep their economic wealth intact. And that's good for the investor, right? That's why Harvard Endowment and Yale and Harvard and all of these large institutions, that's why they have a 500-year life expectancy. They just buy a capital asset like real estate or equity. And the reason that your favorite company lives for 5 or 10 or 15 years and goes bankrupt is because they don't have any assets, right? It's like, again, I've said before, they're like type 1 diabetics, right? They can't store energy. Bitcoin is insulin. It's insulin to the type 1 diabetic, right? If you're a company, you need Bitcoin. It's like your insulin. All of a sudden, you can store economic energy. You're not doomed to decapitalize yourself.